Today we're going to take a look at the highest yielding Dividend Aristocrat stock out there, which is Walgreens Boots Alliance, ticker symbol WBA. There's a few reasons why I wanted to do an in-depth look into this stock. First, it's currently offering a dividend yield that's close to 9%, which is really attractive for investors looking for current income or even dividend growth. As previously mentioned, Walgreens is currently a Dividend Aristocrat as they've been able to grow their dividend for 25 consecutive years and counting, and they're also in fact the highest yielding Dividend Aristocrat currently out there. It's also one of the rare opportunities to get a high dividend-paying investment that's taxed as qualified as opposed to non-qualified. Unlike most high-yielding investments like real estate investment trusts and business development companies, which are taxed at your current income rate, WBA is a rare exception in that it offers a taxed advantage distribution. So WBA can be an appealing investment for people who are trying to invest in dividend stocks in a non-retirement account if you're trying to live off dividends before retirement. Plus, I've noticed that some people here on YouTube, especially one popular investor in particular, seems to be doubling down on this stock, seeing it as a great opportunity right now.
WBA, I think it's an easy money stock, and that's why I put 7 figures in the stock.
So with all this in mind, let's take a look at this stock and see if it's a great buying opportunity right now for high income, or if it's too dangerous to even consider. Walgreens Boots Alliance is a multinational holding company that owns retail pharmacy chains. Here in the US, we're probably all familiar with the drugstore chain Walgreens. They're a major pharmaceutical store that's currently the second most popular pharmacy chain in the US behind CVS. According to their website, they currently have 8,886 stores in all 50 states, including DC, Puerto Rico, and the US Virgin Islands. About 78% of the US population lives within 5 miles of a Walgreens pharmacy. They filled approximately 819.6 million prescriptions in 2022, including immunizations. Over in the UK, they own the health and beauty chain Boots, who have approximately 2,200 locations across the UK, Ireland, Thailand, and a few other countries. This company has some other stuff going on besides just owning pharmacies, as they hold investments in a range of different healthcare-related businesses. In my opinion, one of the company's biggest moves as of recently is partnering with a company called VillageMD. These are like a chain of primary care physicians that provide general health services. What Walgreens has been doing this year is opening up VillageMDs inside of some of their pharmacies. In my opinion, it seems like a good business move, as doctors can write prescriptions that can quickly be filled within the Walgreens, or they can recommend products that Walgreens sells. Plus, the majority of Americans live really close to a Walgreens anyway, so it does make physicians more accessible. But according to their latest investor results, it looks like their VillageMD sector isn't profitable at this point yet, but the company is growing this segment and they've been working on becoming profitable. But on top of this, WBA also owns or invests in several other companies, including Cencora, which is a medical wholesaler, and CareCentrix, which is a post-acute care company. But the large majority of WBA's revenue still comes from retail sales within their drugstores. So right now, this company is going through a major transitional period. With online alternatives now picking up steam, especially with Amazon now entering the pharmaceutical industry, Walgreens knows that they can't just remain a brick-and-mortar business. So they've been making attempts to modernize their business by adding more services. That's really the main selling point for this stock, which is that as the company moves in a new direction, right now is the best time to jump on board according to some of these influencers. The market seems well aware that Walgreens will still need to update their strategy if they're going to remain relevant. If we look at their stock's share price performance, we can see it's down over 40% for the year, and going back even further, we can see it's been falling for a very long time. WBA peaked in July of 2015 at almost $100 per share, which has since fallen by over 77%. Despite this though, the company still holds the coveted Dividend Aristocrat status, which is impressive for any company to achieve. So we need to try and determine if their dividend is still going to be safe going forward. The stock's payout ratio is about 46%, which according to most sources, a payout ratio between 30 and 50% is ideal for these kinds of companies. I know I normally talk about BDCs, REITs, and so forth, all of which have much higher payout ratios, but these companies use different metrics than consumer staples like Walgreens, and they have higher payout ratios because they're required to pay out most of their earnings to shareholders. So although 46% might seem really low and therefore ultra safe, it's on the higher end of what's considered good for a consumer staple. But looking at this metric isn't too concerning, so let's shift our focus onto their financial statements to see how they're doing. We'll start by looking at their income statement. From the top, we begin with their revenue, which is currently near an all-time high. This is one of the biggest selling points of this stock. If they're recording record revenue, that should translate into record profits, right? Well, we need to keep going down this statement to see if that's going to be the case. The next thing we need to look at is their cost of revenue. Cost of revenue is the total cost of manufacturing and delivering products to consumers. It represents the direct costs that are associated with the goods and services that WBA provides. If we look at this metric, we can see that this is also growing, indicating the cost of Walgreens products is increasing. If we take revenue and subtract cost of goods sold, we get gross profit, which is where we see another issue. We can see that since about 2015, gross profit has basically flatlined for this company, which by the way, remember what happened to this stock in 2015? It's when the share price peaked for WBA. So despite increasing in revenue, it appears that their expenses have also been growing at almost the exact same rate. If we go down to net income, stockanalysis.com is showing that it varies a lot from quarter to quarter, but starting in about 2019, things have really swung up and down for this company. Going over to their statement of cash flow, we can also see another concern, which is located under free cash flow. Free cash flow represents the money that WBA has available to pay dividends to shareholders and also pay their creditors. This number has steadily been going down for many years and turning negative for a few quarters as of recently. It's another big concern for this stock as the company hasn't had much money available to pay its dividend, which they've been growing for many years. So with these things considered, after looking at their financial statements, WBA is going to have a really difficult next few quarters. At their current dividend rate, things are probably going to be really difficult for them to keep growing their dividend going forward. Additional cracks in this company have also been showing, as just last month, the company's CEO, Rosalind Brewer, stepped down from the position. She only held the position since March of 2021, so it was a relatively short period for her. Before coming to Walgreens, she was the chief operating officer at Starbucks, and she was on the board of Sam's Club. Overall, it seems like a really mediocre pick to lead Walgreens, as Brewer only had experience primarily in retail. And with the company moving away from retail and instead pursuing more emphasis on medical services, I think it would have been an awkward position for her to fill considering she doesn't appear to have any experience in the medical field. As I was making this video, it appears another executive apparently just left the company. A few days ago, the chief information officer left Walgreens, and on top of that, the company just lost its chief financial officer back in July as well. So there might be some more additional drama going on behind closed doors here. But another important thing to keep in mind is that historically, the stock has always announced a dividend increase every July. Apparently, however, last July, Walgreens did not announce a dividend increase for the first time in decades. They didn't cut the dividend or suspend it, but they decided to keep the dividend at the exact same rate. According to this article, though, not all is lost for their Dividend Aristocrat status. It says, Walgreens' fiscal year ends in August, so it's still possible the company can have an out-of-cadence dividend increase sometime in its fiscal year 2024. If we look at their dividend distribution history over the last 10 years, though, you'll notice that as of recently, they've really slowed down the rate in which they're growing their dividend. Historically, they were growing at about 2 to 4 cents per share every year, but starting in 2020, they were only growing it by a penny. According to Seeking Alpha, their stock has a current 5-year dividend growth rate of 3.2%, which isn't too bad, but again, it's been slowing down quite a bit. So is WBA worthy of consideration for income or dividend growth investors? In my opinion, it's a very high-risk kind of holding. This company is not only going through a pretty serious transformation period, but there's also a lot of drama going on within the management team. I think the likelihood of a dividend cut for WBA is likely, or at least they won't be able to grow it by the end of 2024. Oftentimes, when a company is going through a really serious transformation or they're really struggling financially, a dividend cut can be really beneficial to their finances. Anyone holding or thinking about holding this stock should consider it to be more of a speculative kind of holding. In the long run, WBA can be successful, but there's a good chance the dividend at its current rate will have to be sacrificed in order to better position themselves for long-term success. But with that being said, that's going to wrap up today's video. If you're interested, feel free to check out my Patreon where you'll find an Excel sheet of all of my holdings updated monthly. Plus, it'll give you access to our Discord channel where we discuss higher yielding types of investments. With that being said, thank you all so much for watching today's video. If you liked what you saw, then feel free to hit that like button below and click subscribe if you want to see higher yielding investing strategy content. Again, thank you all so much for watching today's video, and until next time, take care.